Happy holidays, investor friends. I'm Michellemarki, and during this time of year, you might be wondering, are we going to have a Santa Claus rally, or how much diversification do you need in your stock portfolio? Well, legendary investor Charlie Munger answered this question at the 2019 Daily Journal Corporation's annual meeting, where he talked about his not-so-secret investing trick to success, and also he told the story of an old woman who made some brilliant investing moves during the Great Depression back in the day, and also he gave you something to keep in mind if you're wanting to compound your money for the long term. So if that all sounds good to you, please be sure to like and subscribe to my video and YouTube channel and enjoy Charlie Munger and his cheerfulness.
The idea of diversification makes sense to a point. If you don't know what you're doing and you want the standard result and not be embarrassed, well, of course, you can widely diversify. Now, nobody's entitled to a lot of money for recognizing that because it's a truism. It's like knowing that 2 and 2 equals 4. But the investment professionals think they're helping you by arranging a diversification. An idiot could diversify a portfolio, or a computer for that matter. But the whole trick of the game is to have a few times when you know that something is better than average, and invest only where you have that extra knowledge. And then if you get just a few opportunities, that's enough. And what the hell does you care? You own 3 securities and J.P. Morgan Chase owns 100. You know, what's wrong with owning a few securities? Warren always says if you lived in a growing town and you owned stock in 3 of the best enterprises in the town, isn't that diversified enough? The answer is, of course it is. They're all wonderful places. And that Fortune's formula, which got so famous, which was a formula to tell people how much to bet on each transaction if you had an edge. And of course, the bigger your edge, the more close the transaction was to a certain winner, the more you should bet. And of course, there's mathematics behind it. But of course it's true. It's perfectly possible to buy only one thing because the opportunity is so great and it's such a cinch, or only 2 or 3. So the whole idea of diversification when you're looking for excellence is totally ridiculous. It doesn't work. It gives you an impossible task. What fun is it to do an impossible task over and over again? I find it agony. Who would want to do it? And I don't see why. My father had a client. He was a lawyer in Omaha. He had a client whose husband had a little soap company. And the guy died, and my father sold the soap company. This woman was one of the richest people in town in the middle of the Depression. And what she had was a little soap company in a big mansion in Omaha's best neighborhood. And they sold the soap company. She had a mansion in the best neighborhood and $300,000. But $300,000 in 1930-something was an incredible amount of money. A little hamburger was a nickel, a big hamburger was a dime, and the all-you-can-eat cafe in Omaha would feed you all you needed to stay alive for 2 bits a day. I mean, $300,000. Well, she didn't hire an investment counselor. She didn't do anything. She's a wonderful old woman. And she just took that and she divided it into 5 chunks. And she bought 5 stocks. I remember 3 of them because I probated her estate. And it was, one of them was General Electric, one was Dow, one was DuPont, and I forget the other 2. And then she never changed those stocks. She never paid any advisor. She never did anything. And she bought some municipal bonds. She never spent her income. And she bought some municipal bonds from time to time with the incomes. By the time she died in the 50s, she had $1.5 million. No costs, no expenses. And I said, how did you decide to do that? And she said, well, she said, I thought electricity and chemistry were the coming things. She just chunked it all in and sat on her ass. I always liked that old woman. My kind of a girl. But it's rare. You know, but if you stop to think about it, think of all the expense and palaver that she didn't have to listen to, and all the trouble she avoided and zero costs. And of course, what people don't realize, because they're so mathematically illiterate, is if you make 5% and pay 2 of it to your advisors, you're not losing 40% of your future. You're losing 90%. Because over a long period of time, that little difference causes a 90% disadvantage to you. So it's hugely important for somebody who's a long-term holder not to be paying a big annual toll out of the performance. And of course, there are a few big-time advisors now who are using indexation very heavily. And of course, they're prospering mightily. And of course, every time they get somebody, it's just agony for the rest of the investment counseling business. And this is a very serious problem. And I think these people who are used to winning as old-time value investors who are now just quitting the profession, that's a very understandable thing to do. I regard it as more noble than staying in, with, playing along with the denial. It's an interesting problem. You can see I'm not trying to make your morning. I'm just trying to describe things the way they are. But this business, why does Li Lu succeed so mightily? Well, partly he's sort of a Chinese Warren Buffett. That really helps. And partly he's fishing in China, not in this over-searched, overpopulated, highly competitive American market, and there's still pockets of ignorance and lassitude in China that gave him some unusual opportunities. The first rule in fishing has always been fish where the fish are. And the second rule of fishing has always been don't forget rule number 1. And Li Lu just went where the fishing was good. And the rest of us are like cod fishermen who are trying to catch cod where the fish have been fished out. It doesn't matter how much you work when there's that much competition. Every little idea I see in the world, some are going after. I sat once on an investment committee at the University of Michigan, and in came one of their successful investors, located in London. And what had this investor done in London? He decided to invest in sub-Saharan Africa. And the only marginal securities were a few banks that traded in the pink sheets. So he would buy very tiny quantities of these banks. And every time some poor person got tired of having the money in the mattress and put it in a bank, he did it a little better. And of course, he made a lot of money. Nobody else was investing in little tiny banks in Africa. But the niche was soon filled. What the hell do you do for encore after you put your clients' money in a bunch of little tiny banks in sub-Saharan Africa? The niche gets filled quickly. And how many wonderful niches are there going to be when some guy in London is buying all these tiny little bank stocks in Africa? It's hard.
Hi, Mr. Munger. Mm-hmm. My friend Michel and I were from Barcelona, and I have a question for you regarding long-term investment and compound interest. So I tried to remember if it was you or Einstein that said that compound interest was the strongest force on Earth. And in the last few years, with the very low interest rates out there, it's been difficult to find opportunities for having a long-term compound interest-based strategy. So beyond investing in Berkshire, value investing, or index funding, where would you invite us to find opportunities for long-term investment where compound interest is really that force?
Well, my advice for a seeker of compound interest that works ideally is to reduce your expectations, because I think it's going to be tougher for a while. And it helps to have realistic expectations, makes you less crazy. But I think that, they say that common stocks from the aftermath of the Great Depression, which was the worst in the English-speaking world in hundreds of years, to the present time, maybe an index has produced 10%, but that's pre-inflation. after inflation, it may be 7% or something. And the difference between 7 and 10 in terms of its consequences are just hugely dramatic over that long period of time. And if that 7 in real terms that may have been achieved starting in a perfect period through the greatest boom in history, starting now, it could well be 3% or 2% in real terms. I mean, it's not unthinkable you'd have 5% returns and 3% inflation or some ghastly consequences like that. And so the ideal way to cope with that is to say if that happens, I can have a happy life. Because why shouldn't you be happy in spite of the fact that the civilization wasn't quite as easy as it was for my generation? And now beyond that, when it gets more difficult, how should you do it? Well, the answer is because it's going to be very difficult, you should work at it. And if all that gets you is 6% for a lifetime of work instead of 5%, you should be cheerful about it. If you want to hit it out of the park easily, you should talk to Jim Cramer.